Hello and welcome. The team at Pro Tax Accountant has put this guide together to walk you through everything you need to know about UK car allowances and mileage for the 2025-26 tax year. We're going to figure out if that extra cash in your pocket is a real perk, or maybe a bit of a hidden cost. So let's just dive right in with the big question, the one that probably made you click on this in the first place. That car allowance your company gives you, is it genuinely a good deal, or could it, believe it or not, be costing you more than you think? Well, we're about to find out. First things first, what is a car allowance? Simply put, it's a cash sum your employer pays you to cover the wear and tear, the fuel, all the costs of using your own car for work. But, and this is the really crucial part, HMRC doesn't see it as a tax freebie. Nope. To them, it's just extra salary. And here's where the problem starts. Because that allowance gets added right on top of your salary, it can very easily and very quietly push you into a higher tax bracket. You can see the 2025/26 bands right here. You cross one of those lines, and suddenly a much bigger chunk of your earnings is going straight to the taxman. Let me make this crystal clear. Let's talk about Oliver from Manchester. He's on a salary of £45,000, and he gets a £6,000 car allowance. That sounds great, doesn't it? But you add those together, and his taxable income is now £51,000. That little jump means $730 of his money is now being taxed at 40% instead of 20%. Ouch! That so-called perk just got a lot less perky. Oh, but it doesn't stop there. It's not just income tax. You also get hit with national insurance on that allowance. For 2025/26, you're paying 8% on it. And your employer, they're paying nearly 14% on it too. It's like a 1-2 punch that really reduces the actual cash value of that allowance. And here's a quick pro tip. This one's for you if you're in Scotland. You've got to be extra careful because your tax bands are different. That same $6,000 allowance could push you into a 42% tax bracket way sooner than it would for someone down in England. It's so important to know these regional differences. Okay, now it is absolutely vital that we clear something up. A point of confusion that catches so many people out. We cannot mix up a car allowance with mileage reimbursement. They sound similar, but in the eyes of HMRC, they are worlds apart, and knowing the difference is key to getting your money back. So let's put them side by side. On one hand, you have the car allowance. It's that fixed cash sum, it's taxed as salary, and you can spend it on whatever you want. On the other hand, you have mileage reimbursement. This is totally different. It's paid per business mile you drive, and here's the magic word, it can be tax-free. And these are the official tax-free rates from HMRC. They're called Approved Mileage Allowance Payments, or AMAP for short. For cars and vans, it's 45 pence a mile for your first 10,000 business miles in a year, then 25 pence after that. Now, fun fact, these rates haven't actually changed since 2011. Remember that. Right. So if you're getting a car allowance, but you're also driving a ton for work, you might be feeling a bit hard done by. Your taxed allowance probably isn't covering your real costs. Well, the good news is there is a way to get that overpaid tax back from HMRC. This is where you can start getting proactive. It's a fantastic little thing called Mileage Allowance Relief, or MAW. Think of it as your secret weapon. If what your employer pays you doesn't add up to the full 45 pence per mile that HMRC allows, you can go directly to HMRC and claim tax relief on the difference. And before you think this sounds like a mountain of paperwork, it's actually pretty straightforward. Step 1, and I cannot stress this enough, you must keep a detailed log of your business miles. Dates, destinations, purpose, mileage, everything. Step 2, you do the math. What's the difference between the full AMAP amount and what you got? Step 3, you claim online through your government gateway account. And step 4, you get your money back, either as a refund or a better tax code for the year. Simple. Let's look at Fiona, a freelance consultant. Her company gave her a £5,000 allowance. She drove 12,000 business miles. Now, if you do the maths, that's less than 42 pence a mile. So she logged everything, claimed the shortfall through MAR, and boom, a £780 tax rebate. That is real money right back in her bank account just for keeping good records. Okay, so claiming relief is an awesome way to react to the situation. But what if we could get ahead of the game? What if we could be more proactive? Let's talk about some smarter, more tax-savvy ways to handle your whole vehicle strategy. And hey, here's a quick one for all the freelancers and self-employed people watching. You've got a choice to make each year. You can either use those simple AMAP mileage rates to calculate your expenses, or you can claim for the actual running costs of your car. Fuel, insurance, repairs, the whole shebang. It is always worth running the numbers to see which method saves you the most tax. Now for employees, one of the most powerful things to look into is a salary sacrifice scheme. The name sounds a bit scary, but it's brilliant. You basically agree to give up a chunk of your salary before tax is taken off. In return, your employer gives you a brand new leased car. Because you've sacrificed pre-tax salary, you save a bundle on both income tax and national insurance. And you really don't have to be an accountant to see how powerful this is. Just look at this chart. The difference in the real take-home benefit between a taxable car allowance and using salary sacrifice for an electric vehicle, it's huge. And it's all because the tax on electric company cars, the benefit-in-kind tax, is incredibly low right now. And speaking of EVs, here's a quick heads up for what's coming. That low benefit-in-kind tax is going to start creeping up slowly in the next few years. Also, from April 2025, new electric cars will have to start paying road tax, or VED, for the first time. But even with these changes, salary sacrifice for an EV is still one of the most tax-efficient ways to drive a new car. Phew! Okay, we have covered a lot of ground here, so let's just pause for a second and pull everything together into a quick guide, the absolute must-know points you need to take away for this tax year. All right, here's your cheat sheet. Number 1. Your car allowance is taxable income. Say it with me, it is taxable. Number 2, track every single business mile. Your logbook is your best friend. Number 3, if you're not getting the full 45p rate, claim Mileage Allowance Relief. Don't leave that money on the table. 4, look at the alternatives, especially salary sacrifice. And finally, number 5, if you're self-employed, remember you have options. So that brings us right back to where we started. Now that you know all this, what's the answer? Are you really making the most of your car allowance? Or have you been accidentally leaving a pile of your hard-earned cash on the table for HMRC? Look, if any of this feels a bit complicated, or if you just want to know what the absolute best strategy is for your personal situation, the smartest move is to get some expert advice. The team at ProTax Accountant live and breathe this stuff. You can contact them directly on WhatsApp or give them a call on 07985 689912, or just pop them an email. They'll know exactly what to do. And finally, if this guide has been useful, why not stick around? Make sure you hit subscribe on the ProTax Accountant YouTube channel. They're always putting out clear, straightforward advice just like this to help you make sense of the often confusing world of tax. Thanks so much for watching.